Stop scrolling. Silver just did something it only does before supply breaks. Right now, not theory, not someday, silver's trading in the high 80s to low 90s, pressing toward $100 per ounce after a 30–35% rip to start 2026. Most people think this is hype. It's not. Here's what they're missing. Lease rates are spiking. Premiums aren't compressing on dips. COMEX registered inventory is bleeding lower while price climbs higher. Dealer lead times are stretching from days to weeks. These are stress signals. If you're stacking physical, watching from the sidelines, or trading futures, you're either early or late, nothing in between. If you're watching now, you're ahead of the headlines, but only if you understand the pattern underneath the price. This isn't about hitting targets. It's about recognizing the mechanism before it repeats. Your job? Understand what happens when $100 doesn't slow silver, but exposes it. Before we go deeper, subscribe if you haven't. We don't chase headlines here. We track flows. And comment watching if you're tracking these signals in real time. I want to know who's paying attention. Here's the setup. Silver's up roughly 30–35% since January. That's not unusual by itself. Silver rips sometimes. But this move is different from 2020's COVID panic and different from 2011's momentum mania. This time, it's simultaneous. Investor inflows are accelerating. Industrial demand is pulling harder. And physical supply channels are showing visible strain. Dealers are slower to quote prices. Premiums that normally compress when silver pulls back a few dollars, they're sticky. Delivery windows that used to be 2 to 5 days, now it's 1 to 3 weeks in some markets. That's the surface. Here's the hidden layer most people miss. Silver lease rates, what it costs to borrow physical metal short-term, are spiking quietly. That signals stress in short-term availability. Retail and wholesale premiums aren't falling on pullbacks, which means supply isn't loosening when price dips. Exchange warehouse inventories are drifting lower even as price rises, an inversion that historically precedes rationing behavior. And positioning data shows paper longs growing after the move, not before. Chasing, not leading. These are the whispers beneath the headlines. They're louder than price. Think about that. Price is what everyone watches. But stress always shows up first in the mechanics underneath. Let me show you the pattern. I call this the physical drain loop. Here's how it works. Silver sits in two worlds, paper and physical. Paper trades in contracts, fast, liquid, leveraged. Physical trades in actual metal, slower, heavier, finite. When industrial demand pulls metal out of inventories faster than paper markets can reprice the risk, price doesn't climb smoothly. It accelerates in steps, in bursts, not a grind, a staircase with sudden jumps. Think of it like a fire hose feeding a growing fire. As long as water pressure matches demand, flow stays steady. But narrow the valve while demand increases, pressure spikes, flow becomes erratic. Eventually something gives. Silver's the hose. Industrial users, investors, and stackers are the fire. The valve is physical availability. Right now, that valve is narrowing. Here's why this repeats across cycles. Industrial users don't care about price the way traders do. They need metal to manufacture solar panels, electronics, batteries, medical devices. If they can't get it, production stops. So when they see supply tightening, they don't wait for lower prices. They buy forward. They lock in deliveries. They pull metal early. That's demand acceleration, not from speculation, but from necessity. At the same time, investors and stackers watch industrial users scramble. They interpret that urgency as validation, so they increase their own buying. Not because they predict higher prices, but because they recognize tightening. Now you've got two groups pulling in the same direction. But here's the kicker. The paper market. Futures, options, ETFs, reprices risk based on visible signals like open interest, fund flows, and technical breaks. It doesn't see lease rate spikes or dealer delays in real time. So by the time paper catches up, physical is already tight. And when paper tries to catch up quickly, it accelerates the very thing it's trying to price. Physical drain. That's the loop. Demand pulls, supply tightens. Paper reprices late, new demand enters. Tightening accelerates. Circle this. Price lags stress until it doesn't. We've seen this before. 2010 into 2011, early 2020. Each time the same sequence, hidden tightening, ignored signals, sudden acceleration, just never at this scale. Why scale matters. Global industrial demand for silver is higher now than in any previous cycle. Solar panel production alone is consuming unprecedented volumes. Electronics demand hasn't slowed. And investor appetite, after years of watching gold, is rotating into silver for leverage and supply scarcity plays. So the fire hose analogy? The fire's bigger this time. Not telling you to buy, showing you the structure. Your job is to recognize the pattern, not predict the exact timing. Could reverse tomorrow, could grind sideways for weeks. But the mechanism? That's repeatable, that's observable. This is where most people get trapped. They see price move and assume the move is the story. It's not. The move is the symptom. Stress is the story. And stress is showing up right now in ways most traders never look. Now let's layer in the second mechanism, the $100 valve. Psychological levels don't work the way most people think. They're not resistance. They're not caps. They're pressure valves. Here's what I mean. When silver approaches a big round number like $100, three things happen simultaneously. First, attention spikes. Media covers it. Retail searches for it. People who ignored silver at $70 suddenly care at $95. Second, hesitation enters. Some holders think, this is my exit. Some buyers think, too late now. The market pauses, testing conviction. Third, stress either dissipates or concentrates. If supply loosens, dealers can quote freely, premiums compress, lease rates stabilize, $100 acts like a ceiling. Price hesitates, pulls back, consolidates. But if supply doesn't loosen, if premiums hold, lease rates stay elevated, and dealer delays persist, then $100 doesn't cap price, it exposes the shortage. Think about it. $100 invites participation. New buyers enter. Existing holders decide to add. And if the market can't supply that incremental demand without further tightening, price doesn't grind through $100. It jumps. Imagine you're a dealer sitting on limited inventory. Silver's at $97, you've got buyers calling. Normally you'd quote tight spreads and move metal. But your suppliers are slow to restock. Your premiums are already elevated. And you know if you sell what you have now, replacing it will cost more. What do? You widen spreads? You quote slower? You ration? That's not manipulation. That's self-preservation. And when enough dealers do that simultaneously, the market reprices violently. Now zoom out. This isn't unique to $100. It happened at $50 in 2011. It happened at $30 in 2020. But $100 is different because of what it represents psychologically. It's the threshold where silver moves from precious metal with industrial use to viable gold, alternative for institutional flows. Can't know if it breaks this week or next month. Not predicting, watching signals. What I'm watching, how the market behaves on pullbacks. In a normal rally, price dips and stress eases. Premiums compress. Dealers catch their breath. Lease rates normalize. In a stressed rally, price dips and nothing loosens. Premiums hold. Dealers stay cautious. Lease rates remain elevated. That's the tell. Watch what happens when silver pulls back from $92 to $87. If premiums drop from $4 over spot to $150, that's relief. If they only compress from $4 to $325, that's stress holding. Watch what happens when price pulls back and nothing loosens. That's when you know the drain loop is still active, not advice, pattern recognition. But here's the compounding factor most people miss. The paper market doesn't just reprice stress, it amplifies it. When futures traders see physical tightening, they go long. When they go long, open interest rises. When open interest rises, clearinghouses demand more margin. When margin requirements increase, some traders exit. But the ones who stay, they're more convicted. And convicted longs in a physically tight market create feedback loops. They don't sell on dips, they add. So pullbacks don't relieve pressure, they compress it. I've seen this play out in copper, palladium, and silver itself in prior cycles. The pattern is consistent. Once physical stress reaches a threshold, paper volatility stops shaking out longs. It attracts them. If $100 breaks, the market changes character. It's no longer a trade. It's a repricing event. And repricing events don't give you clean entries. Here's what you need to sit with. The real question isn't whether silver hits $100. It's whether the market can supply metal after it does. Think through the sequence. Silver breaks $100. Media explodes. Retail rushes in. Institutional flows start rotating from gold for leverage. Everyone who waited suddenly wants exposure. Now ask, where does the metal come from? If dealers have inventory, they sell. If ETFs have metal, they issue shares. If industrial users have stockpiles, they release some. Price stabilizes. The market absorbs demand. But what if dealers are already stretched? What if ETF inventories are committed? What if industrial users are hoarding because they see the same supply signals we're watching? Then what? Then you get rationing. Not formal, not announced, just behavioral. Dealers quote wider spreads, delivery times extend further, premiums gap higher, and the paper market, which assumes infinite liquidity at the right price, discovers that physical availability has limits. That's the exposure risk at $100. Not that it can't break higher. That breaking higher reveals how tight the market really is. And once revealed, the market doesn't slowly digest that information. It reprices it fast. We don't know which path we're on yet. Could be controlled grind. Could be volatile chop with rising stress. Could be a supply shock that changes the game entirely. But we'll know soon. Because $100 isn't just a level, it's a test. And the market is about to take it. Let me give you the scenarios I'm holding in my head. First scenario, controlled grind higher. Silver breaks $100, consolidates in the low 100s, then grinds toward 110, 120 over weeks or months. Premiums stay elevated but stable. Dealer delays persist but don't worsen. Lease rates spike occasionally but calm down. Who benefits? Patient stackers, futures traders with wide stops, holders who don't panic on 8 to 12% pullbacks. Who gets trapped? Late chasers expecting immediate continuation, over-leveraged longs who can't handle volatility. Second scenario, volatile pullbacks with rising stress. Silver tests $100, pulls back to mid-80s, then retests as stress builds. Each dip shows less premium compression, shorter dealer relief, faster lease rate spikes. Price eventually breaks $100 violently. Who benefits? Buyers on dips who watch stress signals, traders who respect ranges, stackers who accumulate systematically. Who gets trapped? Weak hands who sell dips in fear, momentum chasers who buy tops, anyone anchored to the idea that pullbacks mean failure. Third scenario, supply shock repricing. Silver breaks $100 and gaps to 115, 125 in days as physical shortage becomes undeniable. Premiums explode, dealers stop quoting or ration heavily, lease rates spike into double digits, paper market scrambles to catch up. Who benefits? Early stackers, long-term holders, anyone who positioned before the break. Who gets trapped? Everyone waiting for the right entry, shorts caught off sides, late institutional flows chasing. No idea which we get. Can't know timing, only structure. But here's what I'm tracking this week. First, lease rates in the 1 to 3 month range. Normal behavior is flat, near zero, occasional small moves. Stress behavior is sudden spikes above 2 to 5%, sustained elevation. Why it matters. Lease rates reflect short-term borrowing costs for physical metal. Spikes mean someone needs metal now and is paying up for it. That's the earliest stress signal. How I interpret it. Single spike equals noise. Multiple spikes over days equals pattern. Sustained elevation equals shortage. Second, retail premiums. Normal behavior is they compress on price dips, expand on rallies, mean revert quickly. Stress behavior is they hold or rise on dips, gap higher on rallies, stay sticky. Why it matters? Premiums tell you if supply is responding to price signals. If price drops but premiums don't, supply isn't loosening. How I interpret it? Compare premium behavior across multiple dealers and geographies. One dealer equals anomaly. Widespread equals signal. Third, COMEX registered inventory. Normal behavior is stable or rising as price climbs, fluctuates with deliveries. Stress behavior is steady bleed lower, declining even as price rises. Why it matters. Registered inventory is metal available for delivery against futures contracts. Declining inventory during a price rally means physical is leaving the system, not entering. How I interpret it. Weekly trend matters more than daily noise. Consistent decline over 4 to 6 weeks equals structural drain. Fourth, dealer lead times. Normal behavior is days, reliable quotes, instant availability on standard products. Stress behavior is weeks, delayed quotes, call for availability messaging. Why it matters? This is tangible evidence of supply tightness. Shows up locally before it shows up in exchange data. How I interpret it, check multiple dealers across regions. Local issue equals one dealer's problem. Widespread equals market-wide constraint. Fifth, gold-silver ratio behavior. Normal behavior is smooth moves, gradual compression or expansion. Stress behavior is violent compression, erratic swings, sudden ratio breaks. Why it matters. When silver moves faster than gold, it signals either speculation or supply dynamics unique to silver. Violent compression often precedes silver volatility spikes. How I interpret it? Ratio moving from 90 to 85 over weeks equals normal. Ratio moving from 90 to 80 in days equals stress building. These signals don't work in isolation. You need combinations. Example. If lease rates spike but premiums compress and inventory rises, lease spike is noise. But if lease rates spike, premiums hold, and inventory bleeds, that's confirmation. Your job is to watch the cluster, not obsess over single data points. What could disrupt this? Volatility spikes that shake out week longs before the move continues. Policy headlines, Fed pivots, tariff changes, geopolitical flare-ups that shift flows suddenly. Liquidity squeezes in futures markets that force technical selling despite physical tightness. False breakouts above $100 that reverse hard, resetting sentiment. Dollar strength that pressures all commodities simultaneously. Can't control these, can respect them. If you're trading, respect volatility and size positions for whipsaws. If you're stacking, accept that pullbacks are part of the path. Not commands, your approach. But understand the asymmetries. Downside risk, silver pulls back 10–15%, premiums compress slightly, stress eases temporarily. Upside risk, silver gaps through $100, supply tightens further, repricing accelerates beyond what charts suggest. Those aren't symmetric. Plan accordingly. Here's where we are. Silver's pressing $100 after a violent start to 2026. The move is real, the stress is real, and the signals underneath are louder than the price action on the surface. We don't know if this breaks higher immediately or consolidates first. We don't know if $100 holds or fails. But we do know the pattern. Physical drain loops create nonlinear price moves. Psychological valves expose supply stress. And when both mechanisms activate simultaneously, markets don't reprice smoothly, they reprice in bursts. If you're watching flows instead of just headlines, you're already in the informed group. If you're tracking lease rates, premiums, inventory, and dealer behavior instead of just chart levels, you're ahead of 95% of the noise. Your job isn't to predict the exact timing, it's to recognize the structure, respect the volatility, and position yourself where you can handle the range of outcomes. Not advice, pattern recognition, could reverse tomorrow, could explode higher next week, but the signals we're watching, those are observable, repeatable, and they work across cycles. So here's my ask. Comment watching if you're tracking these signals in real time. I want to hear what you're seeing locally. Premiums in your area, dealer delays, delivery times. The more data points we share, the clearer the picture. And if you've been stacking, trading, or just paying attention, drop your experience below. What are you noticing that others might miss? If you haven't subscribed, do it now. We're building a group that doesn't get shaken out by headlines or trapped by late entries. We watch what matters. Final insight. Price is the last thing to know. Stress always shows up first, in lease rates, in premiums, in delivery windows, in the quiet strain dealers don't advertise. And right now, stress is screaming, stay sharp, watch the signals, and remember, this isn't about being right, it's about being ready when the market changes character. See you in the next one.